All right, we are recording. This is part 3 of the pension lecture. Now we're going to talk about pension expense. In the prior video, we were talking about the amount recorded on the balance sheet is going to be the pension plan assets net of the projected benefit obligation. For pension expense, there are 5 components of pension expense. You'll see this format obviously in your textbook, but also on CPA Prep and lots of other places. These 5 components are mentioned over and over. The first thing I'd like to say about that is 1, no problem, 2, no problem, 3, no problem, 4, no problem, 5, big problem. Okay, so actually we're gonna, and you will find that 1, 2, 3, 4 are gonna be pretty much a piece of cake, and all the struggle is right down here in number 5, okay? We're going to do an overview here, and then we'll have a slide for each component of pension expense. But it is true, once you have them lined up, all you do is add them up. All right? So service cost. This is a number that comes from the actuary. You get that number, and you add it. Interest on the liability comes from the actuary. You get that number, and then you add it. This is a piece of cake. All right, no problem. Actual return. Not so bad. Actual return is the return on all the stocks, bonds, real estate, and whatnot that are part of the plan assets. That will also come in a report from the pension plan administrator and or the actuary. Now, if it's a positive number, so positive return, then less expense. Negative return, and we'll see this again, so then you add to expense. And I don't think that relationship's difficult to think of. Let's say you put $1,000 in your retirement account today, and then whatever you invested in went up 1,000 times. You're going to have to put little or no money in after that. So it will reduce your future funding payments, your future contributions. All right. Amortization of prior service costs. Well, one thing that's different is these are actuarial numbers. The amortization of prior service costs, while we get the prior service costs from the actuary, this has to be the accountant calculates this one. All right, so that's a little bit different. But in terms of what it does to pension expense, it's always an increase. All right, so not so bad. Add service cost, add interest cost, also called interest on the liability, add actual return to expense when it's a negative return, subtracted from expense, credited expense when it's a positive return. Amortization of prior service cost, while it's going to be a little bit tricky to calculate it, most of the time you'll just be given the number and you add it. Finally, gain or loss, it's complicated. So we'll break it down in the next slide, but really here, let's not even bother. Okay, so 1, 2, 3, 4, 5. 1, 2, 3, 4, you're almost done. And 5, we got to do some work. So service costs, you need to understand the definition of service costs. We already understand the effect on the expense. It's the actuarial present value. So that means the actuary projected an increase in cash flows and then present value those cash flows. And that increased the projected benefit obligation. And it's for the benefits attributed to employee service during the period. So there are several components to the benefit in the contract. One of them is typically for each year you work, you get a percentage. You get what they're called points in some plans. So let's say for every year you work, an employee works, they get 2.5%. What does that mean? 2.5% of whatever their average salary is for the last 5 years they worked. Okay. Once they get that benefit, the actuary will project the cash flow of that 2.5% in the future based upon the future salaries, how much longer they expect them to work for the company, when they expect them to retire, when they expect them to die. Kind of sad, I know, but that's what actuaries do. and then they get the number that's just due to the service this year. So the service cost will always increase the obligation and always increase pension expense. Okay, but it's not, when you hear the word service, you may think, oh, that's all the cost of maybe sending out payments to retirees and managing the plan assets. The service refers to the service, the employee service is work for some time period. Typically, we'll be talking about a year. So a service year is 1 year of service. All right. If you took like leave for half of the year, then you'd only have half a service year. All right. So that's service. Interest on the liability. Before we look at the definition, let's just point out something. If you have an amount here of 100 and it grows to 110, then it just got bigger because time passed. Then it would grow to 121 and so on. Okay. So the actuary projects all the future cash flows way down the road. So the actual cash flows for the actuary are more like this, like 0, 1, and then dot, 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 dot. Let's say this is one employee and it's 30 years later. And then they start paying money and 31 and dot, dot, dot to who knows, some N, right? Well, all of this gets discounted back to here. Now with that 110 and 100 I showed you, if nothing changes, no service is provided or there's no change in the plan, just moving this way, the amount gets larger just through the discounting effect, okay? So present value increases as cash flows get closer. All right, so that's what the interest on the liability is. So this says interest for the period on the PBO outstanding during the period, and that's true, but it's also increase in PBO due to passage of time. So if all the benefits were frozen today and all we did was move closer to when the benefits had to get paid, the present value would get larger, all right? The special rate we use for the PBO is called the settlement rate. And the idea is that if you were going to retire, would you wait 30 years to get all those cash flows, or would you take a lump sum? What discount rate would you have to get to be indifferent between taking all the money today or taking it in retirement? So that's what the settlement rate is going to be. But the main thing is know that the settlement rate is a rate at which, well, they can settle, but it's the settlement rate is used for the interest cost. Okay, exclusively used for the interest cost. All right, so that's interest on the liability. Again, in terms of, please just tell me how to calculate pension expense. All you got to do is add it when you see the number. Excuse me. Actual return on plan assets. This is exactly what you think would be. Increase from interest, dividends, realized and unrealized changes in the fair value. So realized is you bought a stock for 100 and sold it for 110, that's 10. Unrealized is you bought it for 100, it's worth 110, but you haven't sold it, you still have $10 of gain. And it can be plus or minus, but the relationship's really easy. A positive actual return decreases pension expense, that is credits, right? So we decrease expenses with the credit. A negative actual return debits or increases pension expense. All right. Fixed relationship, not difficult to get that one. Amortization of prior service costs. This is a little bit complicated. All right, so we talked about service cost. That's the increase in the obligation because one of your employees provided, let's say, another year of service, which entitles them to 2.5% more in retirement. What's the prior part about? Well, what this has to do with is retroactive benefits. To be a qualified plan, a pension can never take away benefits. A company can't take away pension benefits without a judge's approval. So what tends to happen is sometimes pensions will increase their benefit. For example, they'll start a pension plan they never had before, and they said, if you've been with the company, we'll give you benefits for up to your 10 prior years of service. So those are retroactive benefits. You didn't have the benefit before, they changed the pension plan or add a pension plan, and they're going to give you benefits for work you've done prior to either the change or the adoption of the pension plan. So these retroactive benefits often cause huge increases in the obligation, which means you'd have to dump a large expense in 1 year. So what FASB or GAAP allows is that the prior service costs, which increase the PBO, instead of going straight through net income, it's going to go to other comprehensive income, and then it's amortized to pension expense. So these benefits are allocated to pension expense over the remaining service years of the affected employees. So what that means is you have somebody who got a retroactive benefit at age 40, we expect them to work 25 more years. You can amortize it over that period. So the prior service cost amortization always increases. What happens is it's amortized from accumulated other comprehensive income prior service cost. So these OCI accounts that we talked about takes the pain out of this big hit to net income. First, it debits OCI, closes it to accumulate other comprehensive income. AOCI has a normal debit balance, and we amortize by crediting. So the entry would be like this, and put it up here, AOCI. Already got it wrong there. Amortization, remember, it's a systematic reduction in a financial instrument or intangible asset account. So this is related to a financial contract, a pension. So we have pension expense and AOCI, prior service costs. All right, so you'd increase the expense and reduce stockholders' equity. Interestingly enough, I mean, this is no change to total stockholders' equity. You decrease one stockholders' equity account and increase another. All it's doing is making the accumulated other comprehensive income go through pension expense. Okay. All right, so that's 1, 2, 3, 4, and here's 5, and it's getting complicated. So for 5, I'll call this 5A and 5B, and later we're going to have 5C. So they really kind of shoehorn all these into one. The asset gain or loss refers to, we're going to see gain or losses related to the pension plan assets. The liability gain or loss refers to gain or losses related to the projected benefit obligation. All right, so we can have 2 types of gains and losses. All of these go to other comprehensive income, gain, loss, which you'll also see as AKA, also known as OCIGL. All right. All right, so here's the asset gain or loss. Actual return, let me move this over a little bit. think it's better in a column. You have the words down there, but I like what I'm about to do is kind of, I think, a little bit easier to see. Actual return minus the what's called the expected return will equal the asset gain loss. Okay, so very simply, your actual return, let's say your investments earn $110 and you expected 100. Well, then you would have, this is happy face, a gain, right? So this is, where's my little dot, number 1, okay? Second quarter, or second scenario, you got 90, but you're expecting to get 100, minus 10, frowny face loss, okay? So this formula will always work, and you could flip it around, but I think this, putting the actual return first, then your negative number is a loss and your positive number is a gain. All right. So it is just the difference between expected and actual, but if you set it up with actual minus expected return, then the negative and plus kind of are more intuitive. All right, now here's the rule. The rule is a little bit counterintuitive and is easy to get flipped around. So if it's a loss, decrease pension expense, credit or decrease pension expense. Wow, okay. If it's a gain, debit or increase pension expense. This will seem counterintuitive, especially we just did actual return, negative actual return, increase pension expense, positive actual return, decrease. This is counterintuitive and it's a little bit complicated. You'll see it more as we go through the problems, but basically this asset gain or loss was designed to offset too much of a positive return, too little of a positive return, or a negative return. You're going to see by using this asset gain or loss in combination, so asset gain or loss, asset GL, net actual return means pension expense adjustment equals the expected return. All right, that's kind of a little bit complicated, but let me just say this asset gain or loss adjustment, this is a little bit unnatural. Follow the rule. Okay, try not to go with your intuition on this one. Just follow the rule. The big picture intuition, once you get a little more familiar, should come through a little more, and you'll see how you really have to look at the adjustment net of the actual return to see why the FASB created this rule. Okay, so now there's a liability gain or loss. This one's a little bit easier to deal with, but you have to recognize the language. And here's the key thing: due to a change in actuarial assumptions. As soon as you see the key language, you know it's a liability gain or loss. This does not affect pension expense directly, okay? It can increase or decrease the PBO, all right? So actually this should just be none. So this is none, all right? Not directly. And the last one that I'm just going to mention and in this presentation here is a corridor amortization. All right. And what's going to happen is if the OCI balance gets too large, then we're going to adjust it and run it through pension expense. So if it's a credit balance, then we're going to have to amortize it. And we do that by crediting the pension expense and debiting OCI gain loss. If it has a debit balance, we're going to end up debiting, increasing pension expense, and amortizing the gain loss by crediting it. Okay, there's a lot more to the corridor here, but this is another GAAP required adjustment to pension expense. Okay, so we're just teeing it up. You don't have enough information to do anything with it at this point. But know that this is a further little wrinkle that you have to take care of to complete calculating your pension expense. So as I said, the asset gain or loss part is really where you're going to be doing all your work, and we'll go through it stepwise, and you'll see it's not too bad, not too overwhelming. All right, I'm going to end this here, and we'll look at a little bit in the last one more video, and that'll be it for this this series of videos with the assurance of learning quizzes you have to take.